All right, great move today again on stocks. So like the fourth day in a row, and I think like eighth out of the past 11 days we've gone up. So we're continuing this strong move. Big difference in leadership today. So I'm going to break this down. We're going to break down the technical charts. We're going to talk about different time frames, intermediate expectations, short-term expectations, long-term expectations, how that's reflected on what we're seeing in the market forecast chart, as well as other charts. And then we'll take a trade today on a stock that kind of balances those expectations and how we might be able to profit from that. So let's go ahead and get started. Today is Wednesday, June the 3rd, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P with the market forecast indicator. As you can see, a nice move today, gap up to the upside, and a big move during the day and finishing higher, up over 1.33%, getting up on the S&P to the 78%. Remember, this is a very key level for the S&P 500, because not only do we break above that bounce of a high, remember this sell-off occurred because of the Russia oil. That's what really exacerbated the coronavirus issues. And remember also too that it was right around here that we started closing everything down, but the oil spat started right there and really dropped things down big time between Russia and Saudi Arabia, and we started closing things down. But you see, the drop that we had after the close downs lasted like 2 weeks, so or 3 weeks, 2.5 maybe. So that wasn't nearly as big of a factor, as it took longer to recover what we lost during the oil spat. And then now we've recovered, to the top of that initial bounce we had, which happens to line up with the 78% retracement, which means, if you recall, once you break through that level, like we have already on the NASDAQ 100, the Qs, when you move it up to today's high point there, we've already broken through that level. That means that we have a new trend. We've started a new trend. Actually, you don't see it here, but it would actually be from 100 to 0 in this direction. But we've already passed through that line, and this is actually on the current, looking for any kind of noise. Look, we can pull down the 23% retracement, which would not be a retracement, right? We don't start a retracement until you break that level. It would just be kind of a noisy up and down drop, right? You can go up and down inside this area and not change a thing. In terms of, you might get light pink shading, but you wouldn't get dark pink shading, which is what happens when you break the 23%. For an example here, if I were to show you on this Fibonacci, when we came off of the June 3rd cluster there, and we came up to that level, and if I were to throw on the Fibonacci retracement with that 23% line there, so you can see that. You see how, these 2 days right here, light pink shading, yellow line, just fine. Once we broke it, then we went to intermediate pullback, right? Then we went to dark pink shading and a red line. And we went all the way down on an intraday basis to the bottom of the retracement zone. But we were kind of trading in that area in the retracement zone, got back out, and then finally got back up above the 23% there. And you can see the same thing happen on this pullback. We actually came back in, stayed above it for a while, came back in, used that 62% or 50% in this case, rallied back up above the 23% right there. That's where we got the green line and the dark pink shading, and away we went on a new trend. So that kind of move here is what we look for to happen once you break this. And again, why is this bounce up so high versus back over here where we didn't bounce up so high? It's because the drop that preceded it wasn't so big. There was some chatter here online. A lot of chatter online here about this rally, right? This is the biggest 50-day rally that we've had off of that March 23rd low point, and it is, right? So great. That's the reality of the situation. But the other reality of the situation is that the biggest 50-day rally ever, well, not technically ever since 1957, but the biggest 50-day rally ever actually followed the biggest 23-day drop ever. Right, so that drop from this high to that low, which is actually the 1 year high and low, the 1 year high and low on a really big range, all occurred in 23 days so far in 2020. That's the yearly high, that's the yearly low. These for the S&P, not for the NASDAQ, of course. We're approaching the all-time highs again. But that was it. That was the biggest low of all time. And we have now since bounced off of that with a really decent move, right? That move in 50 days, this move in 50 days here is the biggest ever. So that makes sense. Big moves to the downside are followed by big moves to the upside. But the flip side of this coin is that now look at where we're at. So in the last half of this 50-day run, so the last 23 days, because again, it's keeping with the same 20 time frame of this drop. The last 23 days we're up over 7.25%. Well, if you look back in the last so many years, that's usually where we peaked, right? And if you notice, after all this, over the next 23 days, we went flat. At best, we went flat, if not negative. So keep that in mind. That doesn't mean we won't go flat like today. As you can see here, at the beginning of 2019, after we peaked here with a really good run, up well over 7% in 23 days, we continued higher. It was actually right there. We continued higher, but because of that drop, by 23 days we were flat. Right there, we were flat. So after this pullback, and then we went up again, and then 23 days later, we're flat. So just because we expect that we'll be flat in 4 days at best, doesn't mean that we're going to go down now or just go sideways for the next 23 days. We can go up. Over the next 5-10 days, we can keep going up. It's very strong momentum here. We might go up to, you can see some of these peaks went past 7.25%. They went up to 8-9%. But again, there's usually some choppiness later that brings it back to brings this rate of change down towards zero, if not on a lot of these others through zero to the other side. So again, you can see like a drop to 23% would not be considered retracement because it would be down. We would still be in this area. It's not till you break the 23%. We can get a very bullish move off of that low point, and that would bring our rate of change over 23 days down to zero, if not a little bit below zero, if we were to make that move, depending upon how quickly we make that move. So keep that in mind in terms of how bullish we are, even just in the 4-week period, in the short term, and that's kind of reflected in the near-term line being as high as it is. I mean, this is the highest. The near-term line on the S&P right now is the highest of the entire recovery so far. It was a higher before. We were at these levels when we were bullish, but right now during this little rally, this is the highest near-term line that we've gotten. You notice the momentum line though, because again, the strong gap that we had in the morning, the momentum line is still flat. We're not starting the day down and finishing the day up with a strong move to the upside. We're starting the day pretty strongly up, and you can see that here in this chart. We started the day with a pretty decent move, about almost 0.75% higher, and we finished the day 1.33%. So again, half of today's gain occurred overnight. That's why we're not getting the momentum line back to the upside. But again, the question now is, with these momentum line peaks here, where's the next momentum low going to be? As we've seen in the past, that's been extreme, and that usually means that we'll make a move back down towards the 23% retracement, at least, right? And you can see what ends up happening. Sorry, let me do this here. What ends up happening if I were to move this down and then this up to this current move, if we do peak at this 78% line, if we do peak right here, at least even just temporarily, we can pull down to the current 23% line of the current move and get a yellow line. Depending upon where we close, we can get a yellow line in the dark pink shading down towards what is now some support in this area at 29.42. If you look at the Bollinger Bands, that would be right about 29.42 would be right in this area, right where my cursor is. So right at below the point of control, but there's another volume node which pretty much is the same point of control. It's almost as big. So that would be acting as our support level, right where that dotted line is. So and interestingly enough, it would be into this gap, in this gap that we've talked about before. Over here, we'd be down filling in to this gap. 29.42 would be up into this area. We'd be at the top of the gap on SPY. So it kind of gives you an idea of how that would be a pretty decent drop into that area, into this point of control. that would be a pretty decent drop, and it would be nothing but noise. But it would be enough noise to bring the rate of change down at best to that 0 level. And considering the seasonality of June, which we all know tends to be weaker, wouldn't be very surprising for the next 23 days to be relatively choppy up and down and finish towards where we started, a week and a half ago. All right, before I look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over the subscribe button right here. Hit the red button, subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video. And number two, you want us to do another one tomorrow. It's a quick way to give us feedback. We look to see what you're thinking. If you like our videos and you want to let us know, just one click right now while you're watching. If you don't like our videos, you don't have to click on anything. Also, comment. What did you get out of our videos? What questions or comments do you have about anything I talk about, or for that matter I didn't talk about, that relates? Post those down in the comment section. Join our website at marketscholars.com. There's a link popping out right up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos at davidsettle42. And follow me, join our Market Outlook Facebook group that we've created. All right, if you're watching us on our Market Scholars blog, we invite you to check out other things that you see on the page, including our Market Outlook live trade review videos. So all the trade ideas I do in past videos, we monitor and we manage all the way to the time that we close them in these videos. So if that's of interest to you, check those out. You can click on that link there. Also, all of our classes, all of our trading rooms are listed here. You can click on this view more. That will show you more. Again, our monthly subscribers get access to all of our trading rooms and all of our in our live trade review videos here. The premium subscribers, you can see what you get by clicking on premium. They get, in addition to all of that, also the Q&A sessions, the coaching sessions, the group coaching sessions, as well as all of our custom content and tools, premium tools that we have. Also, engage with us here. Click on social media. Click this heart. It opens up a new window. Hit the like button. Hit that thumbs up. Do the same thing with Facebook. Again, that benefits us because the more likes and retweets these posts have, the more Twitter and Facebook will promote our content to all of our followers on our on these accounts. It will benefit you because Twitter and Facebook will promote content in your timeline from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, let's come back to the charts and let's take a look here at the long-term chart. There we go. You can see it's really holding this breakout, the 200-day moving average. So a very strong move. Again, this is great. In terms of being bullish, we've cleared the 200-day, the 62% retracement. We're now approaching that 78% retracement and making potentially making another run. You can see again another example of this over here when we had this big decline from high to low. And if I were to throw on the 78% retracement there, put on this dotted line, you can see we were kind of flirting. We got above the 62 and the 200, which happened again coincidentally to line up. We broke through that. We hit the 78. We stayed there for a few weeks before finally breaking through. That's kind of when, okay, now we're here, we're bullish. There might be a little bit of a pullback, but that's okay. This trend, this golden cross environment is holding, and away we go to the upside. And that's where that will be up in this area. Once we get to that point, you can see how close we are to a golden cross. And remember, we're already there on the NASDAQ, right? The NASDAQ 100 especially. We're already there on the NASDAQ 100. We're already through that 78%. We're already easily into this golden cross environment. So we are set up and ready to go on this particular index. And the idea is it's most likely going to lead us. The Dow is flirting with that its 200-day moving average, and so is the Russell. So the more these break through themselves, then the more likely we are to really get going on this trend and to break the 78%. And that's why, again, you continue to see this kind of catch-up trade because they're so far behind where the leadership is. So the leadership's not necessarily dropping, it's slowing down, and we're playing catch-up here. Either that will lead to some choppiness in the short term as we've lost the leadership that led us during this rally while this plays catch-up, or we'll at least get, like I said, a flat period from a rate of change perspective until the Russell catches up and we're able to then finally break out, and everything now is kind of from a Dow theory confirming each other. Let's take a look at the 3 green arrow chart. You can see 3 green arrows across the board. Great on the S&P 500. Trading easily above the 8-day moving average. The MACD is rising. Its moving average is rising. And the stochastic's moving average is easily entrenched. So very bullish intermediate trend is really entrenched now. Doesn't mean that we won't get 23% retracements, because remember that doesn't even that at worst produces a light pink shading, and that's it. But we are we're not looking for we're not going to be falling off a cliff anytime soon, barring any, of course, unexpected news announcements. Where that market sentiment line on the S&P is crossed up above 50. That signals 6 to 9 months. Maybe some weak intermediate pullbacks in between, but once it gets above 50, as you can see, it was this whole time over here. Once it gets above 50, the expectation it did over here, it got above 50. Then that's a minor intermediate pullbacks in the meantime, if you consider this kind of the all one and then that one there. But other than that, we were bullish for months by the time we peaked in February of 2020. So that's what we have to look forward to if we were able to break that 78% retracement. Let's see here. Going to the back to the 3 green arrow chart. I also wanted to show some of these the RSI above 60 and holding, great. CCI above 100, great. Never did get above 200, but at least it's trading up above 100. The DMI, you can see we're getting to 30. We're back below 20 now, great. Very, very bullish patterns here. Ichimoku trend above 5, above this, great. On the weekly chart, we're not quite there yet, right? So you can see there's the market sentiment thing I told you about, right? When it got above 50 over here and we really took off. Well, you can see the bullish trend that it established when it did that. And there's another bullish trend, and there's a noisy period over here during Q1, Q4. And there's another noisy period here. So again, once we do get going, then we can get a good market sentiment rally. The problem is, what this is telling us is this big rally we've had, which has been so bullish now that we're getting all these breakouts, like this big rally up until about right now has just been a function of how big the drop was. Now that we're getting all these confirming kind of breakout indicators, it means that we might now start to get back on, if I were to kind of draw a line here, if I were to draw this line kind of coming along this trend, right now we can kind of get back on this trend and steady move higher, right? We moved up, we moved way down, we moved back up to that trend, and now we just kind of steadily move along the way with that market sentiment line rally, similar to what we had here, down here, if it will let me draw it there, and similar to what we had here as well. All right, now let's take a look at the intraday and look at this move again. Look at this, is a 4-week range. That's the 7.5%. Why we talk about this window, this 4-week window, and typically the band, the stretched band in 20 days, which is 4 weeks, is about 5%. So we're outside of that band. We're outside of that 5%. We are at a 7% move in 23 days, and that's actually over here. So that you can see in a few more days, if we hold up here in a few more days, that 7% is going to get bigger. Because the drop, the low points, a lot lower than we were 20 days ago. But still, it's a pretty decent move from low to high point, so it's pretty stretched. And again, a move down to the point of control would be nothing. Like that's where the 23% retracement is. It would just be a noisy drop, but it would fill in gap, and it would fill in the rest of this gap, and it would at least get to the top of that gap. Considering that to be, if that is indeed here, let's go 24. So during this whole rally here, if this is another gap like this one, so we had, actually let's go to 23, sorry. So we had this big beginning gap that held. We had this gap here, too, that held. And now this, if you consider that to be similar to this one and this one, kind of a breakaway type gap where we gapped above those highs, and it will hold. So even just a 23% retracement now would fill in through, the rest of these gaps. And remember, if we're going to do what QQQ has done, which is what we've been doing to the upside, QQQ hasn't filled in that gap either, and it hasn't filled in this gap either, but the 518 gap, it actually has filled in most of that gap. So that's kind of an interesting, and it already has filled in, these other gaps. So that's kind of an interesting function to see if we're going to continue. And you notice QQQ, if I were to go to just the 20-day, sorry, here, let's actually go back here and pull up QQQ. It didn't have as big of a gap this morning, right? So it kind of showed, and it did fill in its morning gap already. As bullish as it finished, it lagged, but you can kind of see it's been in gap filling mode, whereas the rest of the market hasn't, especially IWM, which had a great day today. It's got a big gap there to fill. It's got the rest of this gap to fill, and then of course there's where your 23% retracement level would be if we were to drop into that, drop through this noise area. The other big breakout signal that we had today to kind of say, okay, here we are bullish. And first of all, let's take a look at the volume and the trading range. So the trading range, the volume is right about 92 million. The trading range, when you add the about 2-point gap that we had, got us almost to the ATR. So you can see the ATR and the price drop here on SPY. We are now, there we go. I had to change that back to 14 days, but you can see, we are breaking that 2% mark, which is a really, really good sign, considering how big the ATR has been. It's, we're moving up higher, and this is moving lower, so it's pushing this number down. Below 1% is great. It's the best, right? That's when you're just going to slowly grind higher. But to get back below 2 after being up above it would be a tremendous breakdown on that, and it would coincide with volatility breaking down. You can see it's breaking below 90%, which is, I mentioned on Friday how important that would be to signify that we are bullish. Now we did get a, that just because you break down doesn't mean it's going to hold. Last time we broke below 90%, we did get a bounce in volatility. So keep that in mind. We had a 90% breakdown over here too that led to a bounce, kind of a false breakout that led to some jumps in volatility. But we also see too, and a little bit of a bounce here, but you can see too, when you break below 90, you stay, and that establishes the trend. And you can see it over here as well, with rallies up to the neutral area, but not through it. So that's a very good sign if we're able to break down here below this. You can see below kind of what, 26, 27 on the VIX, and then hold this. Otherwise, you might bounce back up here really quick to 35, maybe 30, maybe in the low 30s. And again, on any kind of move to that 23% retracement, it wouldn't be significant. It probably wouldn't even get above, maybe a little bit above the 95, kind of like this again. And that would probably be it. Again, a trend change now, we're looking to 100, move up to 105%. That's when we say, okay, probably going to break the 38%. We're probably going to start an intermediate trend. But until then, we can bounce. We can get a noisy move. And just bounce up towards 100, and the lower we go, the more likely any bounce would just stop there without being, like I said, trend changing. So to summarize our technical outlook, the intermediate posture is strongly bullish. We're getting a lot of breakout signals. So from an intermediate trend, we're about as bullish as you can be, and our trades have been reflecting that. We got a lot of call options that go out to July and August. They have longer time frames. And so, and they've been doing really well, not just in our market outlook category, if you've been watching those live videos like today's, but also in our directional option strategies. Those longer term kind of intermediate bullish trades that we're really overloaded with right now, have been doing great. The issue is the short term, right? How overbought we are in the short term, what that can mean in the very short term, and that's why we also have some very short-term negative delta trades in our portfolio, just in case. With obviously our long-term portfolio, our passive is like heavily high beta because of how big our drop was. It was pretty decently high beta to begin with, and the bigger the drop, the more high beta we wanted to be for long-term returns, and that has played out really well too. So that's kind of our all the signs show we can get a good run out of this. The short term appears to be, so we just still need to be, from an active trading standpoint, be aware of the short term risks with these intermediate term trades that we have, and be able to withstand the short term risk. If our stop orders are too tight, we can get stopped out of intermediate trend trades on 23% drops. That's not even a pullback, right? Because a pullback doesn't start till you break the 23% retracement. So we don't want that, right? And so that's the idea, is just be aware, like the nature of, the short term is very likely we can get choppiness inside the 0 to 23% level, especially with how bullish we've been in the very short term. From an intermediate trend, though, all of these signals, all these breakouts, all these signs are there to show, we're probably not going to be, bearish, strongly bearish again anytime soon. That we're going to get a decent market sentiment rally out of this for months. So what do you think? Do you agree or disagree with that? Comment down below in the comment section as to why, especially if you disagree, as to why. What are you seeing that either makes you a lot more bullish than that, even with the short-term risks, or a lot more bearish than what we painted here tonight? All right, so now let's talk about what's driving. The biggest driving force right now that we have in risk appetite as a whole is this falling dollar. And this is an outstanding move for broad-based risk appetite. I've told you before, it's hard for the markets to be too bullish if you've got a strengthening dollar, right? And I've told you before that the bear market started in January 2018. We looked at the return since that period. We've been bullish in equities, but mainly in these handful of stocks, especially since the fall of 2018, since that little pullback right there. From that level, we've especially been pretty bearish in these outside of these handful of stocks. But now look, we're getting a pretty decent drop below what would be the 30-week moving average here. That can lead us into this type of move, which would be significant. This is one of the most bullish markets we've had in a while, back in 2017, and even some of these periods coming off of early 2016 was pretty bullish too. And then of course, coming off the 2009 low point where we had this big drop in the US dollar, how bullish that was. In 2013 during the QE3 period, how bullish that was for risk appetite as a whole. So, if we're going to get something like that again here, then, like I said, long-term market sentiment run of 6 to 9 months or more, here we go, right? Here we go. It's just, again, balancing those long-term expectations with intermediate term and then the short-term risks of this big overbought rally. But you can also see too, the other factor that's been a kind of limiter has been the move in bonds, and you can see finally bonds are breaking down that 23% retracement level. Now bonds are pulling back on a long-term basis. Very good sign. We're not quite there in gold yet. You can see it's got a long ways to run, but it's a pretty decently bearish candle with this tremendous divergence on the intermediate line, lower highs with a lot higher highs. So the safety, the biggest fuel for any kind of risk appetite from here is going to be the unwinding of the safety trade, because the safety trade, as you can see, is since 2018, especially since the fall of 2018, has been extremely overbought. So as this safety trade unwinds, where does that cash go? Well, it goes out of risk aversion into risk appetite trades. And that's going to be a function of what leadership we have. And right now, that leadership, as we saw in the late 90s, this is a very comparable period, has been in those technology type stocks. So we'd expect them to continue to lead us up higher. And again, before we look at the sectors here, one more thing to look at, and another good reason about what we're seeing in the markets is the global participation, right? So here's all the 12 largest economies. Look at the breakout moves in China. Look at the breakout moves in Italy and Germany, and Germany up here, and in France. Brazil is breaking out to the upside. Korea breaking out to the upside. So dark green shading, green lines all across the board with some very significant breakout moves. Again, that's the function of a weak dollar, and that's a really, really good sign. Now, when you look at it from a sector perspective, from the U.S., again, we see the same things. There's your technology, there's your cyclical areas still leading their ways up, but now financials and industrials are breaking out, and that's a good sign. And materials and energy are going to start breaking out because of a weakening dollar. Remember, they do very, very well. If I were to go back here to this chart, let's go back to the UUP chart. And you see, okay, how did, from this from this 2007, and let's go to this the daily chart. Right here. So from this period of, let's say, January the 3rd, 2017, to all the way down here to the beginning of 2018, let's say to February the 15th of 2018. So if I were to do a sector comparison chart there, right here, and pull up January the 3rd of 2017 to February the 5th. Again, a big drop in the US dollar and a big move higher in risk appetite, right? And you can see the move. I mean, look at the during this run, technology stocks great, leading the way higher. They were the leadership. They continue to lead higher. But look at energy lagging behind. But look at that strong run right there throughout the that halfway point, all the way up from being down 17% all the way up to past 4%. A function of a strong dollar there. Or weak dollar, excuse me, and then materials is this light green shading. You can see how it outperformed, along with financials and industrials, it outperformed the S&P, and there's your safety trades lagging behind. So that's a function. I mean, at one point in time, a few points in time, materials was the second leading sector. You know, healthcare had a little bit of a run, technology continued to run, and then there's your discretionary, along with financials and industrials. But it was right there, if not beating, you know, the second leading mover. And if I were to come all the way here from this low point, so let's say back on August the 17th of 2017, so August 17th of 2017, to see that energy run, you can see energy and materials, the strength that it has. And again, what does that look like from the US dollar, from that UUP here, from August the 17th of 2017. So come here, UUP. So that would be right from pretty much that period. Oh, there's August 17th. We had some ups and downs, but we had that pretty tremendous down period here that materials and energy just loved, and a little bit of a down period here to start it, some weakness, and then boom. And that's why they rallied so much by the time we got to this February peak in the S&P. So, and you're starting to see that now, right? We're starting to see materials, or energy and materials, start to work their way back up again. And again, a kind of a, you know, along with financials and industrials, a good sign to see these. But, you know, again, they've got a lot of room to make up. They're still multiple percentage points down. So, you know, on the days like today, where the trash leads, you know, that might mean we get some choppiness in the very short term, because eventually we want, as we saw before, you know, that leadership, which has been for years now, QQQ. It just went parabolic here lately. But the those large cap tech names have been the leadership. They continue to be the leadership. We want them to continue to be the leadership going forward, because when this takes the leadership over, that hasn't been a good sign from in terms of like risk appetite going forward from here. Usually is a sign that leadership is changing, and when that kind of huge gap in outperformance corrects itself, as big as it is now, as big as it was in the late 90s, very similar gap that it took multiple years to bring that gap back down to zero by the time we were done with 2002 into early 2003. Alright, so as bullish as we've been in some areas, not everything has been that bullish. And so that's our trade idea of the day. I want to take a look at Medtronic. And Medtronic is about as flat as a pancake as you can possibly be. It's got a little bit of a bullish bias. Its intermediate line's rising. Its market sentiment's rising. Not very high levels, but they're rising. Not above the 60 level yet. And you can see that, you know, we got dark green shading, but we have a yellow line there. If you take a look at its moving averages here on this line, it's really, really... about, again, oops, not that one, so T, there we go. But look at that, it's about as flat as a pancake there. It's like a little missile here going forward. All these lines kind of wrapping against each other. The MACD is about as flat as it can be with its moving average, but a little bit of a bullish bias, and that's okay. If you look at its long-term run, you can see it's right around the, not just the 8, 17, 30, but also the 50-day moving average is about right where we're trading, and it's, you know, got a little bit of a bearish bias below that 200-day moving average. You look at its Bollinger Bands, and there's a reason why we're sitting here. There's a big gravitational pull coming from the, you know, the biggest node on the chart right now. It's kind of, especially with the $100 level too, is kind of keeping it. You know, again, it's got a lot of gravitational pull here. You know, until we break out, and we're through earnings, mind you. So we're through any, you know, that can be an impetus to break out, and we're not quite there yet. You look at its RSI and CCI, and they're about as neutral as they can be. Right? It's been neutral. We haven't gotten above 60. You haven't gotten below 40. It's about as neutral as it can be. Same thing here. We haven't really gotten above 100 for very long. We haven't got below negative 100 for very long. So we're right in the middle. You look at the DMI, and the same thing. It's about right in the middle. Below, you know, right around 20, both of them right around 25. So not really bullish or bearish here. And then you look at the Ichimoku cloud from a trend strength standpoint. On the daily chart, you see how noisy we are. We're just barely above the cloud. That's on the daily, and on the weekly, we're actually still kind of a little bit of a bearish trend according to what we're seeing. But again, pretty noisy. You're transitioning from what maybe is a bearish trend to what maybe will be eventually a bullish trend. But in the meantime, we can trade this sideways action. And we'll do that by selling a put spread at the 20 delta, so selling the 90.87. Well, actually, we'll go to the 90.85 because on the flip side, we'll sell the 105 and 110. So $5 wide on both. That keeps them balanced. So you can see that gives me this trade. Let me show it here. I don't know why it's not. Oh, it's because it's in that account. So there we go. So there's the trade, and those blue lines, you'll notice they show up here. The break-even lines show up here on Medtronic right where we want them to. So we have a resistance up right where the top one is. We have support at the bottom of the value area right where the bottom one is. So as long as we stay around this pole, we make the maximum reward, which is about $400, and we'll risk at most 1,000 in normal position size because we don't have to worry about earnings. But we don't want to lose more than $405 because that's what we're trying to make. So, so we'll make that trade and see if it stays sideways in that range, and we'll profit from it. All right, so that wraps us up for today's video. Again, you heard from me now. Now I want to hear from you. Let's keep this conversation going by clicking on that link. It takes you to our Market Outlook forums. Open up any new threads, reply to anybody else's threads, and let's talk about what we discussed. Remember, you can also comment on YouTube with any questions or comments you have about the video tonight. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video. Follow me on Twitter at DavidSettle42 for more content between the videos, and join our Market Outlook Facebook group that we've created for viewers, as well as our community at Market Scholars, which in this particular forum, the Market Outlook forum, is free. You get access to that for free. So again, thank you. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.